It looks like U.S. stocks will slip at the open today. Yesterday, though, they jumped despite last week's fears of an AI bubble. Our guest says that skepticism is lingering, but data suggests we'll continue to see durable expansion supported by fundamentals. We're joined by Philip Petursson, Chief Investment Strategist at IG Wealth Management. Philip, great to see you. And when we talk about durable expansion, are we talking in particular tech spending?
It's part tech spending, but there's a lot into it. So thank you, Andy, for having me on. We've just released our 2026 outlook, and we've identified 4 pillars that we believe are going to stand up the economy and support growth into next year. And these are monetary stimulus, fiscal stimulus, the AI spending, and then the wealth effect. So it's not just AI. There's everything around it. And we saw that with the third quarter results that most sectors participated. There was only one sector that was down year over year on earnings, and that was the energy sector. Every other sector presented very, very strong earnings growth and surprised to the upside. So this is a good lead-in into next year.
And you're not concerned that eventually the financing will start to dry up for AI until people see sustainable profits from all this investment?
Well, the financing might dry up, and that is something that you're seeing pop up in the news more and more as these large companies now are having to turn to the credit markets to finance some of these AI initiatives. Mm-hmm. But right now, we're still seeing that real money flow through. And so while future investment might start to slow down, we've got a solid core going into next year that we think is going to be very, very supportive. Now, it could be more of a 2027 story where we start to see things turn a little softer on AI because the proof will need to start having to be realized in terms of the investments and then the returns on these investments. But for now, we remain optimistic that the 1 to 1.5% of AI spending going into the global economy as a percentage of U.S. GDP is still going to be fairly solid.
And we hear a lot about this wealth effect whereby households, especially in the United States, when they own stocks, they see the value of their holdings go up and they're inclined to spend. I guess that cuts both ways. If the market did take a big downturn, it would tend to cut into confidence.
It does, but interestingly, the research shows that as a dollar of financial wealth is realized by households in the United States, about 15 to 25 cents of that, or 15 to 25%, is spent. Now, when we see the markets down, it doesn't mean you have an equal decline. Now, I guess it remains to be seen if we were to see a meaningful decline over the near term, what that would do to consumption. But in the meantime, we've had 3 very, very strong years of growth for investors. Think of even your average balanced fund that has delivered double-digit returns over the last 3 years on an annualized basis. This is being realized and being spent by consumers, not only in the United States, but we think in Canada and other areas around the world.
And you note, I think you touched on this, that governments are in stimulus mode, even if the interest rate cuts are coming to an end. Both in Canada and the States, they're talking about big spending or tax cuts.
Exactly. Remember, OB3, or the One Big Beautiful Bill, a lot of those tax cuts come into place at the beginning of 2026, and that is going to be quite stimulative, we think. You're going to have a massive extension of the tax cuts for corporations, but also households. If you look at households earning more than $217,000 a year, they're going to see an average tax cut of $12,000. I mean, that's quite meaningful. We do talk about the K-shaped economy, but it's the consumer that's the top end of that K that is most important to the economy and to stock markets.
So what kind of stocks do you think will do well next year, Philip? Is it possible to generalize?
Well, we think we look geographically first. And so when we look at that, we are equal weight in the United States. So we still have a positive outlook for U.S. equities in 2026. But we see an extension of the outperformers that we've enjoyed in 2025 continuing on in 2026. So this is the Canadian equity market, the TSX. We think international stocks will continue to perform quite well and outperform U.S. stocks. Additionally, emerging market stocks we think are continued or poised to continue to outperform. So we're overweight Canada, international, emerging markets relative to the United States, but we're overweight equity over fixed income heading into the new year.
Right. Sorry, what was that last thing about fixed income bonds?
Right. So we're underweight fixed income relative to the equity markets. We just believe that fixed income is still attractive, but the returns that you're going to see are about 3-4% for a broad-based fixed income portfolio. And we believe the equity markets can do better. Now, as we look through to the real downside risks of the market, and that's the risk of recession, that tends to lead to deep bear markets. We don't see a significant risk of recession into 2026. And so therefore, we have a much higher probability of continued positive returns for the equity markets that should be multiples of what we can get out of fixed income. That's why we're overweight equity, underweight fixed in our portfolios.
And is one reason to be cautious about fixed income the risk of inflation, or is inflation pretty well under control now?
We believe inflation's under control. So when we model it out over the course of the next 6 to 9 months, both in the United States and Canada, we see inflation settling into its targeted range. So in Canada, that's 2% plus or minus 1. We might see inflation a little bit higher in the next couple of months. That's more math related than real price impact related. And then it's going to ease back down closer to 2% by the middle of 2026. In the United States, here too, we have inflation targeted around 2.5%. So a little bit higher than the Fed's 2% target, but still in line with the historical norm. So inflation is no longer a problem for the central banks. We think that the focus is going to shift more towards economic support, and that's where we see 4 cuts by the Fed next year, only 1 by Canada.
Oh, that's interesting. Yeah, well, of course, Canada is well ahead in that cutting cycle. Thank you very much, Philip. Really appreciate it.